Hey everybody, Boris Nasser, BK Forex. Welcome to our Forex Weekly Technicals. Where are the trades for 0526, 0530 of 2014? The last week of May, which could be the final quiet week as we get into some very, very serious event risk in about a couple of weeks. But let's take a look at the charts. And we certainly started to have a little bit more volatility this week, given everything that's been going on. So taking a look at the euro, of course, we had the big reaction off the ECB telegraphing the fact they're going to do a rate cut. Then we had about 2 weeks or a week and a half of just consolidation around this 37, 36.50 level. And we talked about the fact that this 36.42 was going to be very, very key support, which got tested a little bit, got tested, when was it, on Monday or Tuesday, and then came right back up. We came back up to a natural 37 and then came right back down again as the data by the end of the week began to kind of weigh on the evidence that ECB is definitely going to cut rates in June. As a matter of fact, now the question is not so much whether they're going to cut rates, but whether they're going to cut rates and potentially do some sort of a QE or some sort of a weak version of QE with asset-backed securities. Bottom line is, when you look at it from a technical point of view here, we are now perched at a very, very key level. The only thing the bulls, I think, have in their favor is the fact that we did not have enough juice to test the 36 handle today. We came to within about 15 pips of testing it, but there clearly was a lot of underlying support. Into next week, you don't have too much event risk in the Eurozone, but you do have some geopolitical risk, of course, because you have the Ukraine elections, you have the Greek elections, and we'll have to see if the market is going to be strong enough once everybody comes back from the North American holiday. There's actually a holiday in UK as well on Monday, but if, from the holiday on Monday to see if we can drive the move further. The one thing that's keeping this descent on a very, very slow pace is the fact that U.S. rates have just been very negative towards a short euro trade for a while because U.S. rates themselves have started to come down. And the fact that 10-year tested at 250 was the key reason why the euro did not go down nearly as much as it could have. So if you do get this combination of a rally in U.S. rates and a further acceptance of the fact that the ECB is going to be on the negative side of the interest rate spectrum, then there's still more downside potential for now. We did break these key levels for now. Technically, basically, the euro is certainly a sell in the rallies all the way through up to and until the 37.50. Only a close above 37.50 would negate all of this negative structure that we've kind of built up. And therefore, it feels like the lower probability trade right now, or excuse me, the higher probability trade, the lower risk trade, is to simply sell any kind of a bounce here into the zone until and unless we get the 37.50 close, because then that would really negate the whole structure and would actually effectively show us a more or less double bottom formation right over here. A break to the downside, though, is not a one-way ticket. You do have a lot of support here starting 36, 3650, and 3500. So it's probably going to be a slog, but a move to 3500 is feasible, perhaps even all the way out to 3400 all the way down the road. But this 3500 is the yearly lows, so there'll be a lot of battle here to keep the euro at bay. Generally, it looks to be like a slow drip to the downside. It looks to be like a sell the rally kind of a trade. It may even out a little bit for the next couple of days, and in fact, we could rally all the way up to 3,700. But just generally, overall, it still looks to be a selling trade when you look at the euro. Although momentum is not accelerating. That is the only thing that the bulls have in place. Dollar yen, on the other hand, found yet another buy point at this critical level that we looked at, which is the 101 to 175. That was the big basket. We talked about the fact that this 100, 175 level was such a huge catch-all for support, and it certainly proved to be this way over here. The big question now is, so this is the catch-all level to the downside. Unfortunately, this is the repel level to the upside. This 102 to 102.50 has just been maddeningly tough to penetrate. So chasing the trade over here really puts you at a very, very awkward place because you're far away from the stop and you're possibly very close to a resistance point. Generally, it probably looks to be best to let the price action churn itself out and find a much cleaner, stronger break above this 102 level, perhaps even the 103 level, in order to to have more confidence that the bottom in dollar yen is in place. I mean, dollar yen is effectively still trading on this seesaw action in the U.S. yields. The U.S. yields did stabilize at 2.5. Was this the bottom in U.S. yields? If it is, then it's definitely the bottom in dollar yen. If it's not, then it just could be another false dawn, and we could be testing right back down towards this support level. I will say this though: the fact if we do come back down the second time to this 175, 101 level and break it, that break could be a lot more significant. So if we fail here, we fail around the 102s, we've basically created a very negative structure of lower highs and a possible retest of the lows. And if the lows get broken, it could be a much more severe cut to the downside. Cable holding steady, a little bit softer here on the close today. Nothing really going on in cable. Cable is kind of a neither here nor there story. Fundamentally still strong, but BOE doesn't really want to move. It's still going to get the first mover advantage. There is, interestingly enough, I read some interesting pieces this week that argued for a short cable trade, basically saying that nobody is really factoring in the unexpected risk of a Scotland spin out. Will Scotland spin out and go its own separate ways? That is actually a serious consideration, and one I think the market definitely not really paying a lot of attention to. So the Scottish referendum, which I think comes in June or sometime, as to whether they're going to spin out and not be part of the British Isles and be their own separate entity, could definitely wreak havoc within the UK economy, at least as the adjustment is made, and therefore could definitely be one of those kind of exogenous shocks that could push cable to the downside. Definitely worth watching. To the positive side, of course, the UK economy continues to perform well, still going to get the first mover advantage of getting the rates up. So for now, if you're looking at this technically, the structure is not really that great. You got to basically, at this point, a series of lower highs here that are basically telling you that we may be having a little bit of a topping formation. Bottom line is support here, 67.50, 66.50. This whole area, that's really going to be the bargain hunting area where people are going to try to make bids. For now, it looks to be corrective as we stand here. The only buy point on this whole chart here is literally above the 170 level, literally through the big number. Only if we can break the big number will you have a lot of confidence that the bulls have full control of the table. Up until then, it looks to be actually as a sell-off trade, even though it's still at a relatively high point. Aussie dollar is just contained right now in this consolidation of 92, 92.50, basically 92, 93. After having failed, we talked about the fact that there was a danger of failure here at 94. It failed 94 pretty badly. We're kind of consolidating here. It really becomes a matter of another interesting piece of research I read this week was that Goldman Sachs is arguing for a rate cut in June. That is very much an out of consensus view. The market really does not think the RBA is going to cut, and I kind of doubt it as well unless the situation deteriorates. As a matter of fact, if nothing else, we've had actually modestly positive data out of China, stabilization over there, and if you could sort of have just a muddle through 2.5 to 3% growth rate globally, which keeps China afloat, it really keeps the Aussie afloat as well. So support here, 92. Initially, that's a big support area. 92 could become just an optionality trade. In other words, there's just a lot of option defense here, and it's very tempting, of course, to break it sharply to the downside. So there could be a move here to like 91.50, but beyond that, 91 does come back to be pretty decent support. Former resistance now becomes support. So I think Aussie becomes a scaled down buy here as we get closer to these bargain values if we do break it to the downside. To the top side, everything is very chunky, and 92s, 93s, 94s are all forms of resistance here. So all the rallies here are going basically against the headwind. So I'd be very careful on the rallies. Taking a look at the Kiwi, which has been markedly weaker. This is kind of an interesting story. So here's a yield play. Here's a increasing yield play that continues actually on a relative basis, even underperforming Aussie. And what it's telling you is this crumble here, I think, is also very important because this 85 level is just massive support. So just as Aussie could run the stops at 92s, I think the stop build up at on the Kiwi is really building underneath the 85s, and it could potentially take us all the way down to, just as an Aussie, it could take us to 91s. I think it's reasonable to see that it could probably take us close to this 84, perhaps maybe, 84.25 level. That's former breakout, right? This was double top breakout. Now would that become support? There is, the commodity dollars are kind of communicating to us that they are on a relative weakness basis, and could be looking for a stop hunt run if momentum accelerates to the downside. And then lastly, let's take a look at dollar CAD, which is actually performing a little bit better against all of its rivals. The Canadian numbers are kind of weak. I mean, retail sales, wholesale sales were relatively weak, but CPI seems to be staying in place. There really is no change, of course, out of Canada. Canada is trading perhaps a little bit off of U.S. yields as well. But on a relative basis here, what's interesting to me is if you look at Aussie CAD, which really crumbled below this 101 level and really started to decelerate to the downside here, now testing parity. It's really very, very tempting to want to test parity here on the Aussie CAD trade. And if you look at Kiwi CAD, you see very, very big crumbles here. That's kind of really interesting that the Canadian dollar on a relative basis is really starting to appreciate against the Asian antipodians, and that presents perhaps a little bit more opportunity here. So if we have further crumble in the Aussie, further crumble in the Kiwi, one possible way to trade it is not necessarily through the dollar, but through the Canadian cross as well, because it's going to take us down to the 92s perhaps on the Kiwi CAD, and it could take us certainly through parity, which is a really, really big number in the Aussie CAD, and I'll be watching that as a potential break here in the next week as it shows some relative strength. So that's kind of how the week shapes up. Wishing you guys the best of luck, the best of trading. Boris Schlossberg, over and out.